Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. There have been some good signs lately for the housing market, decent auction clearance rates, a pause on interest rate rises, and prices seeming to stabilise in some capital city markets. But according to a new report from Halo Property, it may just be a temporary reprieve. Halo Property is part of ASX-listed Halo Technologies, a global equities research and trade software platform, and is headed up by Warren Hogan, former Chief Economist at ANZ. Warren, welcome back to Fear and Greed.
Thanks for having me on the show, Sean.
A false dawn in the housing market, Warren?
I think so, yes. I mean, there are some markets which I think can perform from here, but I think we've got to be very careful in thinking that the overall correction in the market is over. There are still some extremely expensive markets across the country.
Okay, so is it about the price of houses? Is it about the impact of interest rates still to flow through? Why is it a false dawn?
I think we're seeing sort of the end of phase one, and that is the sort of removal of excessive pricing as interest rates went up. But the next phase for the property market is how is it going to deal with the slowdown in the economy. Now, if we look at what's happening out there right now, there are plenty of jobs. In fact, employment is still expanding at a very healthy rate. Incomes are going up. And of course, the banks are fighting over themselves still to provide funding into the market. But I think as we go through the second half of the year, a couple of things will happen. One, the economy will slow. And of course, if it doesn't, the RBA will be out there hiking rates further. But importantly, one of the key analytics that we employ is the use of the real interest rate to understand where the property market's at. And of course, the real interest rate has only just started rising, and it's going to rise a lot over the next 12 months as inflation falls. And of course, this real interest rate's what's key to the market, just like real wages or real GDP are important.
Warren, just explain to listeners that we talk about nominal and real wages, what real wages actually is describing.
Yeah, so the real wage is, I think, probably the most sort of important concept, because you might see your wage go from $100 to $105, i.e. a 5% increase. But if the cost of everything you buy goes from $90 to $105, i.e. goes up by more, you're actually going backwards. So the real wage is essentially the nominal wage minus inflation. Real economic growth is nominal economic growth minus inflation. And of course, the real interest rate is that interest rate you see out there, whether it's the RBA cash rate or your mortgage rate, minus inflation. And this is ultimately what matters, because that reflects the purchasing power or the real cost to you of what's going on, whether it's the interest rate or wages or so on.
Okay. What about things like migration? We're expecting 650,000 people this financial year and next financial year. Doesn't that put some pressure on prices, floor on house prices? Like, how does that play into it?
Yeah, no, it's a fascinating element of the current situation. And I think there's two things to note here. One, we look at all the markets across Australia, and not all markets are performing the same. So I would note that apartments in the East Coast capital city, that is Brisbane, Melbourne and Sydney, are not only now the cheapest they've been for many, many years, but they will be where the impact of this immigration is felt most acutely. So that's the first thing. I think that despite the fact that we're looking at a further correction in house prices in the capital cities all around the country and regional areas, those apartment markets in Sydney, Melbourne and Brisbane, we are very positive on, and think that investors are going to start looking at that very clearly. The other thing to note is that the impact of migration will be most acutely felt in rental markets as opposed to the demand for new property. And what that will do is push up rents, as we're seeing. And of course, that is inflationary. And that will, because rents are the biggest part of the CPI, and that will put more pressure on interest rates. So I think what you're seeing is that this big flow of migration is actually not going to be the broad-based net positive for the housing market in the short term. It will be for some markets, but for the overall market, the result actually could be higher interest rates and more inflation, which will be negative.
So where do we end up? When does the market actually bottom? How much would that peak to trough be?
Well, if the RBA sort of gets on with it, and I think we will see a couple more rate hikes, I think the soft point for the economy will be later in the year, early next year. And of course, we'll start to see the real interest rates really push up as inflation starts to come down through the course of the year ahead. So at the moment, we're thinking that the next phase of the correction It might not start until we get to spring or late winter. We may see this sort of better market performance continue for a few months, but that next phase will happen through the second half, maybe into early 2024. And I think that's when we're thinking the bottom in the market will be. But again, the caveat on this is that some markets are looking like value now, while some markets are still looking hideously expensive.
Housing remains location, 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 Warren.
Exactly. And then that's why it's important to do your research. And I think this is a critical time for investors. There will be wonderful opportunities present themselves in the year ahead. I think right now they should be looking at these apartment markets. I'm very positive on Sydney and Brisbane in particular. But even beyond that, as we see this next phase of correction hit the market later in the year, there'll be opportunities more generally around the country in early 2024.
Stay with me, Warren. We'll be back in a minute. My guest today is Warren Hogan, Economic Advisor to Halo Technologies. Now, Warren, you have been an economist and among Australia's best economists for many years. Obviously, you're at ANZ for a long while as well. I can't let you go without asking you about the Reserve Bank review last week. Did you read the 300 pages?
I'm not quite there yet, but I've looked at a lot of it. And look, ChatGPT could have written a review,
Right.
in the sense that it's a summary of best practice around the world.
Yeah.
There's nothing too innovative of that. But what this review is a major change in the way the RBA goes about setting monetary policy. And that is, we're going from the old model, which is essentially a closed shop where the senior leaders of the RBA come up with the monetary policy strategy and have a group of eminent Australians provide oversight to that, to what will now be ultra transparent monetary policy committee made up of economic experts, that every move they make will be looked at. There'll be nowhere to hide. And what worries me is that model will create a lot of risk aversion. And of course, the big thing with monetary policy is that they have to look forward. They have to set interest rates now for what they think the economy will do in 18 months' time. And that takes a bit of courage and a bit of foresight. And I do worry that this shift, this modernisation, will make our monetary policy less forward-looking and, by definition, maybe less effective.
Transparency isn't always good, Warren, is kind of what you're saying.
It is, unfortunately. I know it's not trendy to say that, but I think what we're seeing with the Reserve Bank is part of a broader trend of a loss of trust in institutions in our society. Effectively, for the last 60 years, and particularly the last 30 years, we've had a lot of trust in the senior leadership of the RBA and that board to do the right thing. They've had a lot of political cover, and generally they've done an excellent job. They've been one of the finest institutions in Australia and, of course, one of the finest central banks around the world. But the slip-ups that we've seen in the pandemic, combined with this general loss of trust in institutions and this desire for transparency that's part of that loss of trust, has really meant the shelf life for that model has come. And it is a little bit sad. It's a bit of a sad day for people like me who've been following the RBA for, I'm sure for you, Sean, is a big change for them. And I feel very sorry for Phil Lowe. I think he's a great economist, a great Australian, and I think he feels this deeply.
Do you think that there are people from outside the bank will do a better job than those inside the bank? I mean, a lot of the criticisms are fair, so no arguments there. But the one thing about the Reserve Bank, they live and breathe it all the time, and it's very hard to have a one-day-a-week board come in and do it, I'd imagine.
That's right. That's exactly right. But I'm worried about, who are going to be these experts, because they'll essentially be part-timers too. They'll be also almost part of staff. I think what they needed was, on that board of eminent Australians, 2 or 3 practicing independent economists who could, on occasion, when it looked like they were a little bit out of whack, could have a loud voice. And I think that was probably the right solution. But as I said, I think it got past that. The RBA has always generated a lot of animosity in the community, because the people have been jealous of the fact that they have so much power and it's a bit of a closed shop. So I think one day this was always going to happen. But yeah, it remains to be seen. But what's critical now, of course, is the appointments that this government makes. They've come out and appointed 2 unionists to the board, which is pretty bold. And I'd hate to see them stack all these positions that are going to come up in the next 18 months with the same type of people. That would be a disaster. If they're going to stick economic experts on this monetary policy board, they need to be very clear the kind of people they're putting on there, and make sure that they've got diversity as well as collaborative people who can work together as a team.
Warren, thank you for talking to Fear and Greed.
Thanks, Sean. Great to be on the show.
That was Warren Hogan, Economic Advisor to Halo Technologies. This is the Fear and Greed Daily Interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.